This is Principles of Financial Accounting, Financial and Managerial Accounting 2. The faces around the room look familiar. A lot of you are in the right place, and I know it and you know it. There are a few unfamiliar ones. You're new to the course, and I say welcome. We, in first semester, talked about the accounting cycle. We talked about the accounting equation, the debit-credit mechanism, making adjusting entries, preparing financial statements, communicating the information to other people. We talked about closing entries, reversing entries, all those kinds of things. The foundation was presented in chapters 1 to 4 basically. And then we got better at it when we were a merchandising concern. And then we got better at it when we looked at cash and receivables, inventory and plant assets in greater detail. Second semester, we turn our attention to the rest of the balance sheet, primarily that being alternate forms of ownership. First semester, we were a proprietorship owned by one business. Second semester, we're starting out with partnerships and spending 2 chapters on corporations. So in the next 3 chapters, in the next 3 weeks, we're going to talk about businesses owned by more than one person, starting with partnerships today. One of the things that we want to do is talk about the characteristics of partnerships. What's different about partnerships than other organizations that we've encountered? Proprietorships that we've done, corporations that we anticipate. We want to know what's different about these. This is chapter 12. It's not chapter 1. We're not going to start again with the debit-credit mechanism. It's assumed that you know all those things. There'll be some lingo today. There'll be some things in your first homework assignment that you're supposed to already know. And I hope you do. It's a building block kind of thing. We need to know about how to start a partnership. How many problems did we work? How many exercises did we work first semester that said owner invested in the business? The very first thing that happened was owner invested in the business. And we got pretty good at that. We did it so many times. Well, how's that different for a proprietorship? How do we start a proprietorship? It could be as simply as invest cash. First semester? Debit, cash, credit, John Doe Capital. Partnerships? Debit, cash, credit, John Doe Capital. Sound familiar? Yes or no? Yes? And debit, cash, credit, Mary Smith Capital. What's different? Now there's 2 of them. Minimum. Now there's 2 of them. Or, more complicated than that, what happens when we invest assets other than cash? We need to talk about that. That's in your first homework assignment. We need to try to get you ready for that before you leave the room. One of the things that partnerships should do is decide how they're going to divide up income and loss. What if we're profitable? How shall we share it among the partners? What if we have a loss? What are we going to do about that loss? We need to talk about that today. And what about we're so successful others want to be admitted to the business, or we're doing poorly, we need an injection of ideas and energy and money. Maybe a new partner needs to come in and help us get going again. What about admitting a partner to the firm? What about retiring? Or, I'm just tired of working with you people, I want out of this. Or, somebody dies. What do we do when a partner is no longer part of the partnership? It's in the chapter. We ought to mention it. And finally, what happens when we go out of business? We ought to talk about it. Now, we're not going to talk about everything on the list in the same depth. Some things are going to rise to the top and we're going to choose to concentrate on those. But these are all appropriate partnership topics. And some we're going to emphasize more than others. Let's talk about the characteristics of a partnership. How's a partnership different from other forms of organization, proprietorships, and corporations? One of the things you need to be aware of when you go into a partnership with another is that you are responsible for the actions of the others. I can relate it to other kinds of relationships like this. What about roommates? maybe you liked the person down the hall and thought you could get along, but the next year when you moved in together, you started irritating one another, and you were real good friends when you lived apart, but now that you're living together, you're not friends anymore. Or my wife says you don't really know somebody until you've taught next to them in a school hallway. Or how about two people who are dating one another and think it's going to be great, and they marry and it's not so great. They don't squeeze the toothpaste the same way. You never know somebody until you go into business with them, you know? You think you can trust that individual, but when that individual goes out and borrows money in the name of the company, you're responsible for paying it back just like that other person is. When that other person buys what they think is a great load of goods that we're going to sell in our store and make money, and that turns out to be a load of junk, it's your responsibility to sell those goods just like it is that person's. Do you understand how this could go awry? Consider that you're responsible for the actions of that other person. It's of concern. Partners and partnerships have unlimited liability. I already know where we're going. I already know we're talking about corporations the next 2 weeks, and I thought now might be a good time to talk about both. Partners and partnerships have unlimited liability. Shareholders, owners of corporations have limited liability. What a good thing to contrast right this minute. Wouldn't it be great if you understood both a few moments from now? I don't know what that says. Don't even look at it. I tried to turn it off before I came. So, let's say that this business, proprietorship or corporation, has been, raise your hand if you read it. I saw you reading it. You couldn't resist, could you?
It was funny.
At least you didn't have to smile at it after you read it. Now I wonder what it said. Don't tell me. I don't want to know. So let's talk about an unsuccessful partnership or corporation. We're going to do them one at a time. Let's do partnership. Partnership's going bankrupt. Not enough assets to satisfy all the creditors. So here's the entity, the partnership. There's the creditors who want everything the partnership has. There's the owners. Y'all with me here? Yes or no? So the creditors come to the partnership and they clean it out. All the assets are given to the creditors to try to satisfy the debt, and there's more debt. And the creditors just come right on through the partnership and go to the owner's personal house, personal car, personal retirement plan, personal savings. All those things are at risk of satisfying this debt. Unlimited liability. Do you understand it? Contrasted with limited liability for owners of a corporation. Let's do the same story. Creditors, corporation, owners. Creditors come to the corporation. Corporation gives up all the assets they can to satisfy that debt, not enough to go around. Those creditors want more satisfaction. They try to get to the owners' personal assets. The corporation acts as a shield. Shareholders in corporations have limited liability based on this one characteristic alone. If you were going into business, would you rather be a partnership or a corporation? Speak up. Don't make decisions based on one criteria alone. There are many factors, but that's the way you need to consider this one. That's a disadvantage, and if you couple that with the first thing that's listed up there, that you're responsible for the actions of your other partners, that's a double whammy. Everybody who advises about business recommends that when you go into business and you make an agreement, that you make it in writing. Yes, there'll be a lot of verbal discussion, and yes, you can make some agreements, and yes, those are considered contracts, but they're much more difficult to enforce because you don't have the evidence that you do with a written contract. Everybody anybody that gives advice says get it in writing. So, what might we include? Well, some of the things we'd want to include are the topics that I'm talking about today. How are we going to start this partnership? How are we going to let new people come into the partnership? What happens if one of us retires or dies or wants to quit? How are we going to divide up the income and loss? What happens when we go out of business? I equate this to something like a prenuptial agreement. At the beginning of that marriage relationship, you're offended to talk about a prenuptial relationship. You think you're going to be together forever and that it's not going to matter and that you'll never talk about it. To even think about a prenuptial agreement at the beginning suggests that it's not going to work, doesn't it? But if you can, while you're unbiased, go into this partnership agreement and agree on the essentials while they're not happening. Do you understand the difference? When they start happening, you're biased. When they start happening, you want things to go your way. You're not nearly as willing to cooperate and work with your partner when you feel like they're trying to take advantage of you, so you try to take advantage of them. When you're clear-headed at the beginning, get a partnership agreement and get it in writing. Partnerships have limited life. Oh, how confusing. Unlimited liability and limited life. Is this going to be overkill if I talk about corporations right this minute too? Corporations have unlimited life. Oh no. Unlimited liability, limited liability, limited life, unlimited liability. Unlimited life, excuse me. Oh my. Let's talk. So we've got M, N, O, who are partners. And Z comes along and wants to be a member of the partnership. Technically, theoretically, the old partnership goes away and a new partnership begins the very next moment. The life of this entity, the partnership, is limited to those component parts, those people who make up the original partnership. A, B, C, and D are partners, and D dies. Technically, that partnership ceases to exist and another one begins consisting of the remaining partners. Is their Yellow Pages ad going to look different? Is the awning out front going to look any different? Will customers be treated any differently when they come in the front door? Are they going to be able to dial the same phone number and reach the company? Yes. All those things are going to seem the same. But the life of the partnership is limited to these partners who make it up for that duration. Contrasted with corporations that have unlimited life. Do you suppose anywhere in the whole wide world somebody's buying a share of Walmart stock right this minute? Yes or no? Is that too hard to imagine? Did Walmart cease to exist a moment ago and now exist again because that share of stock is now owned by somebody else? You're sleepy. Or something, because that deserved a response. You could have understood that. Did Walmart go out of business and come into business again because one share of stock was traded in the marketplace? No. Corporations have unlimited life. They just keep on going. They're kind of like the Energizer Bunny. There's no stopping them. Yes? Until they specifically decide to go out of business. You can go out of business. But changing ownership in the business doesn't change the entity's existence. In proprietorships first semester, we had one capital account for the one owner and one drawing account for the one owner. And we will continue that mentality into partnerships. We will have one capital account for every owner. 3 partners, 3 capital accounts. 300 partners, 300 capital accounts. You with me? 300 drawing accounts. We're keeping up with it. That's the message we're sending. We'll keep up with it for you. Every partner has a capital account. Every partner has a drawing account. Just like always. Is it okay if I tell you about corporations now? You're aware, aren't you? Not from accounting, but from real life, that when you buy shares in a corporation, you're an owner? Or When you invest in a corporation, you get a share of stock to say that you're an owner? Yes. We're not going to have individual capital accounts for every owner anymore. In a corporation, we're going to give them shares of stock and say, you keep up with it. The message here is, we'll keep up with it. We're going to have a capital account for you. The message in corporations is, here, you keep up with it. Do you see the difference? It's for more widespread ownership. It's considered to be, it's just harder to keep up with. Okay? Do you have that square? Yes or no?
Yes.
I think we ought to talk about the income tax consequences to contrast proprietorships, partnerships, and corporations. I don't think there's a place to write this. If you want to write it down, you can write it on the backside, perhaps. Maybe you just want to listen or watch or think. If you want to write it down, I'm not stopping. Let's talk about the kinds of organizations I keep talking about today. The glance back at the proprietorships, the present moment partnerships, looking ahead at the next couple of weeks to corporations. Let's talk about whether or not they file a tax return. Did you notice that income tax wasn't mentioned first semester? Primarily it's because proprietorships as an entity, our subject for the first semester, didn't have to file a tax return. There was no need to mention it. But partnerships do. So that's why I'm mentioning it. I have an obligation to at least mention this. Corporations file tax returns too. Then the question comes, do they pay tax? Does the entity pay tax? Well, as an entity, proprietorships didn't, which was another reason that we don't mention it first semester. There was no need to mention it. The rub comes when you think about partnerships. They file a tax return, but they don't pay tax. What's up with that? We ought to find out. Corporations file tax returns and pay tax. Well, they're supposed to. Y'all been listening to the news lately? Okay, I won't go there. But what about you and your roommate who have so much in common that are dreaming these same dreams and schemes and thinking about going into business together someday? Have we just struck on the best way possible to have a business organization? Hey, let's go in business together and let's be a partnership. They don't pay tax. Is that what the screen says? Huh? Isn't that what it says? Well, let's answer that other question. Is the income earned by this entity subject to tax? Can you say US of A? In the US of A, proprietorship income is taxed. But the difference is, it's not the entity that pays the tax, it's the person who owns the entity that pays the tax on those earnings. That's why we didn't mention it first semester. Partnerships file tax returns, but the entity doesn't pay tax, but the partners do. The purpose of the partnership tax return is to tell the partners how much belongs to each of them so that they can report it on their own tax return and pay the tax on their own tax return. And corporations file returns and pay tax. An interesting concept, I think, contrast, I think, and I hope that you benefited from that. Finally, on characteristics of a partnership, sometimes we use the term salary to describe the reward that we give to partners, and that's a misnomer. Every time we say salaries, we ought to punctuate it in the air with a little gesture. Employees get a paycheck. Partners, owners of a business, share in the earnings. Ever heard of an income statement? Revenue minus expense is net income? Yes or no? To whom does that belong?
The owner.
The owner. That's the owner's reward. In a little while, even today in class before we leave, we'll say salaries. In homework, it'll say salaries. But it's not a good word to use. Salaries is just a reward of net income allocated based on the time that owners invest. It's an allocation of earnings. It is the earning of the business, the net income, that is the reward to owners. Let's talk about starting the business. I said some things a few minutes ago when I was in introductory mode that really gave it away here, and I shouldn't have said it so quickly. When owners invest in the business first semester, we debited cash and credited John Doe Capital. When owners invest cash in a partnership, we're going to debit cash and credit John Doe Capital and debit cash and credit Mary Smith Capital. And that's in your first homework assignment. Can you handle it? Can you handle it?
Yes.
Yeah.
It just happens more than once. That's easy. But what happens when Company X and Company Y, who've been competitors all these years, they've advertised on TV and run newspaper ads and they've got billboards and everybody in town knows that they're just dueling against one another, trying to get their share of the market. And they decide to lay down their differences, and they think they'll be stronger together, and they decide to form XY partnership. And we've got all these things in this business that we're contributing to the business, and all the things in this business that we're going to contribute to the business. Is it quite as easy as debit, cash, credit, John Doe Capital? When it was cash, it was a whole lot easier to see than when it's all these other assets. When we have investments of things other than cash, we've got a little more thinking to do. You know, when we were a proprietorship and we invested just cash in the business, or even if this were the case of the partnership, so this partner puts in this much cash, this partner puts in this much cash, now we go out and buy some land, now we build a building, now we buy some equipment with this cash. Now we've got invoices, we've got checks, we've got cost. You ever heard me say the term cost before? How are we going to determine cost for existing assets in X's business and existing assets in Y's business that we just give to this new business? There's no invoices here. There's no checks written. How do we know cost? Well, the partners are going to have to agree. The operative word here is that the partners are going to determine the cost based on what they perceive the value of that asset to be to the new business. It is their agreed valuation. And if you were thinking instead of just in observation mode, if you were thinking about the practicality of this, maybe you'd think, well, how on earth would they decide that? So here's a desk that was in the old business and you've decided to contribute it to the new business, and it's a little dented and scratched, but it's perfectly good and we're still going to use it. What's it worth to the new business? Well, maybe you go to the used furniture store and you look around as if you were there shopping to buy one, and you found one in about that condition, and you found out what they wanted for it. And then you came back to your situation and you said, well, over there at the used furniture store they were asking $200 for one that looked about like that. Then let's agree on $200 as being the worth of this one. What's the land worth? What's the building worth? What are the receivables worth? What's the equipment worth? It's the agreed valuation that becomes cost to the new entity. Are you understanding what I'm describing to you? Yes or no?
Yes.
That's in your first homework assignment. I'm going to have to ask you to write down that question in your margin, because I'm not going to finish if I answer it, I'm afraid. One of the important things that we're stressing is about the division of income. One of the important things that partners have to do is, what do we do when we're profitable, and how do we share that among the partners? What happens if they're a loss? How do we allocate that loss to the partners? There are a variety of things that we need to know about this. If they don't make an agreement, then state law takes over, and state law says you'll divide it equally. So if one person puts in a lot and one person puts in a little, you're still going to divide it equally. If one person works a lot and one person works a little, you're still going to divide it equally. A good sales pitch for let's get an agreement and let's get it in writing. Now, when you come up with an agreement, what you're trying to do is find unique ways to reward partners for their uniqueness. Find good, reasonable ways to reward them for what they bring to the partnership. And it's the same story I just told. Maybe one person has a lot to invest and another person has a great idea but very little to invest. Do they get the same amount of net income? Maybe you allocate interest to these two partners. The partner who contributed more would get more of net income based on that part of the agreement only. Maybe the guy with the little bit of money but the great idea has the time to make it happen, but the guy with the money is all busy about all of his other investments and doesn't have time to do it. Do you see the disparity I'm describing here? So let's reward with salary. This person who's there managing it every day and making it happen gets a larger salary, which is just a way to say we're rewarding you with a greater portion of net income based on the time you invested. We try to come up with unique ways to reward them based on their original investment. I've told that story already. We call it interest, but it's not. Based on the time that they invest. I've told that story already. It's called salary, but it's not. They're not employees. They're owners. There are many, many other ways that you could come up with that, and it'll never work out just right. So the partnership agreement should also say how to divide up the remainder. What are you going to do with what's left over? That's all covered in a homework problem. The second assignment for Tuesday, Wednesday is about this very topic, about dividing up net income. And it's an important part of the chapter. I'm going to skip through this pretty fast, this one. I've got an exercise picked out in the book to demonstrate this better. When we admit a new partner to the partnership, we could get that partnership interest two ways. We could buy it from someone who already owns it. Or we could invest assets directly in the partnership. If we invest exactly the right amount, there's not a problem. We could invest more than the capital balance we're going to get, or we could invest less than the capital balance we're going to get. And that would cause there to be a bonus to the old partners to reward them for the good job that they've done, making that person want to pay extra. Or could be because we're stagnant and need a new injection of money and ideas. And we're willing to give this new partner a balance greater than the amount they've invested just because we want them to be part of our partnership so desperately. There's a couple of good exercises that are really good on this topic, and it'll make a whole lot better sense when we have an application for that. I can't do it all today in class. Let's talk about, just real briefly, about withdrawing from a partnership. I've already set you up. It could be somebody who's just tired or tired of getting along with you all, the rest of you in the partnership, or somebody who wants to retire, or somebody who dies. When that partner takes out exactly the capital balance, it's easy. When that person takes out more or less than the account balance, there are some complications. I don't have time to hit them now. I wish I could. It's not going to be one of the things that we stress the most. I'd like to move to something else that we are going to stress more. What happens when you want to go out of business? The process of going out of business is called liquidation. Now, I know it seems that furniture stores have liquidation sale every weekend, but you can just go out of business one time. Y'all with me here? I'm talking about going out of business. The process of going out of business we need to describe. Your two homework problems for second discussion are on this topic. One way to go out of business would be to try to sell off all the assets. To try to divide up all the assets. You take the cash, I'll take the receivables, you take the inventory, I'll take the equipment, you take the land, I'll take the building. Do you think this is going to work out? Is this going to be fair? Are we going to get exactly the same amount? Can we divide up the assets in such a way that we're both exactly satisfied? I got two people in the room seeing the fallacy. Is this going to work? No. That would be a nightmare. An absolute nightmare. Don't you agree? What would work better would be to sell everything. If you sell everything and then all you have is cash, we can divide up the cash correctly, equitably, easily. If you decide to go out of business, it's better when you convert all the non-cash assets to cash. That process is called realization. It's not just an accounting word. May I give you an example of how to use this word, this understanding, someplace else? Come on, I bet you know this. So let's say you buy stock, and you hold it a while and it goes up in value. Do you have to pay tax on it?
No.
I could stand here all day at this rate. Before you enrolled in this class, you should have known. From just living, from just breathing, from just paying attention, you might know this. One more time. You bought some stock, and it went up in value. Do you have to pay tax on it?
No.
Somebody over here told me the right answer. Do you have to pay tax on holding stock that's gone up in value? It was a trick question. You don't have to. When would you have to? When you sold it. What's selling it called? Realization. It's on the screen. It's on the screen in an application to partnerships going out of business. But that doesn't mean that that term isn't used in business other places to mean something similar. That's why this course is required. That's why this course is called the language of business. Because if we can experience some things like that, then we can learn that and apply it to other situations in our lives. When you sell that stock that's gone up in value, you convert it from stock to cash, you've measured that, you've locked into that gain, and you're going to have to pay tax on it. That's, we say, if it's just gone up in value, you don't have to pay tax on it because no realization has occurred. But when you realize it, then you have to. That's the difference. Going out of business is called liquidation. Converting non-cash assets is called realization. Sometimes you're going to make money. Sometimes you're going to lose money. On many assets, once the public finds out that you're going out of business, they want your assets at a bargain price. Okay, so you heard the furniture store going out of... No. Liquidation sale! Liquidation sale! So when you entered the front door of the furniture store, did you expect to pay top dollar for what you bought that day? Why'd you go there anyway? You wanted a good deal, right? You were looking for bargains. Well, when the public finds out you're going out of business, are they willing to pay you full price?
No.
Probably not. You're probably going to lose. You've got a gain on some things and losses on some things. You need to allocate that gain or loss to the partners the same way you've been allocating it since day one. Why change the rules now? We've been allocating gain or loss based on their agreement, and we should continue to do so. We're going out of business. The accounting equation is assets equal liabilities plus owner's equity. Creditors' claims come before owner's claims. Now you've got the money. The first thing you should do with your money is pay the creditors. Their claims come first. And if there is any money left over, you should pay the owners. How much do owners deserve? They deserve amounts that represent the claims on assets. That was a Chapter 1 term. Claims on assets were equities. We learned to call it owner's equity or capital. Claims as evidenced by their capital accounts. So we distribute two things. We distribute gain and loss according to their agreement. We distribute cash according to their claims. I could get you to talk the talk. I could get you to say that back to me. As far as I'm concerned right this minute, from your perspective, it's probably gobbledygook. It makes no sense whatsoever. So the activities that I plan to enter into with you this week, we'll try to make that more clear. In first discussion, I'm going to do some stuff that We'll help you understand that better, and in second discussion, you'll be turning in a homework problem that you've learned out of the book and from class, and you'll understand it better. Liquidations, an important point of emphasis this chapter. So let's do an exercise about one of these things that we want you to know about the division of income. There's an illustration in your book, and there's a homework problem similar to this, where our task is to divide up the profit and the loss of the company. What happens if you're profitable? Who's going to get it? What happens when you're not? Who's going to get it? We generally, in a homework problem, start out simple. We've got this amount of net income and 2 partners. Can you divide that by 2? You know, it's that simple. But we could complicate it with agreements the way we've described them today. How do we reward partners for their unique contributions to the partnership? Read with me. C and D have capital balances of 60 and 40 respectively. The partnership income sharing agreement provides for, should be in quotes, interest. It's not true interest. They're not creditors. They're owners. At 10% on the capital balances to reward them uniquely for their contribution of cash to the partnership. 2, salaries of 15 and 20 to reward them for time. Is it a salary? Yes or no?
No.
No, because they're owners. Salaries are paid to employees. And the remainder divided 2 to 1. Now, some students even struggle with the lingo, struggle with the way it's written. It's a pattern. You say the partners' names in order, and then everything that follows that is in that same order. Do you know which partner got $15,000? Say it. C did. Do you know which partner invested? Well, anyway, I think you get the idea. It stays in the same order throughout. So, if you've just got 1 or 2 things to allocate, maybe you can think it through in your head, maybe you can scribble in the margins, maybe you can figure it out. Where there is a multi-step agreement like this one, my recommendation to you is that you come up with some sort of chart to describe it. You need a description column. You need 1 column for every partner. In this case, 2 partners. And most of all, you need a total column. When I look at your work, when you've messed up, you've generally messed up because you forgot the total column. I hope you can see the value of the total column before we leave the room today. Don't forget the total column. It doesn't have to be this wide. It doesn't have to be printed on the computer. It can be the size of a postage stamp. But don't just try to figure it out in your head. Write it down. Be able to review your work, check your work, find your mistake, prove it, get it right, build your confidence. So, what about the amount of net income? A says, prepare a schedule showing the division of net income, assuming net income is $60,000. When I've got the chart kind of laid out, I'm going to say, this is my goal. This is what I want to allocate. I had $60,000 in net income. Let's see how to allocate it. The problem says they get interest at 10% on their original investment. We've got to account for interest. Second step is salaries. And then there's going to be a remainder. This time I put interest and salaries in quotes because they're good words to describe, but they're not good words to describe. We're not creditors and we're not owners. Interest at 10% on the original balances. $60,000 times 10%, $40,000 times 10%. The first partner gets $6,000. The second partner gets $4,000. In that step alone, we allocated $10,000 of the $60,000 we had to allocate. Are you with me right now? Say yes or no. Yes. Salaries. $15,000 to the first partner, $20,000 to the second partner, $15,000 to the first partner, $20,000 to the second partner, a total of $35,000 in that step, $35,000 of the $60,000. Here's the beauty of the total column. We have allocated $45,000 of the $60,000. How much is left to allocate? I need $15,000, and they're to share that $15,000 how? According to their agreement. According to their agreement, which was 2 to 1. Now, some of you see 2 to 1 in this case real easily. I don't see relationships like that very easily. I have to be very deliberate about them. In life, I contend that you have to write your own fractions sometimes. Even though this one's simple, Let me show you a simple illustration that you can make more complex if the circumstances called for it in the future. If I had an agreement that was described like this one, 2-to-1, I would sum the parts and make that the denominator. What is the sum 2-to-1?
3.
3 is the denominator. The first partner gets 2 parts of that agreement, 2/3. The second partner gets 1/3 of that agreement. So if it was some other fraction, some other amount of partners, some other agreement, perhaps you could figure it out that way. 1/3 of $15,000 is $5,000. 2/3 of that $15,000 is $10,000. The first partner got twice as much as the second partner. Yes? Good. And then we need to sum. 6 plus 15 plus 10 is 31,000. 4 plus 20 plus 5 is 29,000. I would never do this. Never, never, never would I do this, that I did not go one step further and cross-foot to prove that I was in balance. Is 31 plus 29 equal to 60? Yes? So once we've completed the schedule for C and D and know their totals, what's the point? Why did we do this? Is this just a step between us and graduation, walking across the stage someday? Surely there's some reason that we did this in business. Would you think back with me to end of the year procedures for the business we're in, when we've made adjusting entries and prepared the financial statements? We typically prepare closing entries in order to allocate the net income to the owner. I'd like to ask you in class and have you respond, how many steps are there in closing entries? And you'd say 4. What do you close in the first step? And you'd say revenue, and then expense, and then income summary to capital. And we were a proprietorship, and the owner got it all. We'd make an entry debiting income summary and crediting John Doe Capital for the amount of net income. Well, we have newfound information. We now know that one partner earned $31,000, the other partner earned $29,000. Their capital accounts should be increased accordingly. The third step in closing entries is debit income summary, credit Chip Capital, $31,000. Credit Dale Capital, $29,000. That's why we did it. That's the importance of that schedule we prepared. There was a multi-step agreement. The schedule helped us determine each partner's share. The schedule helped us determine how to make this journal entry. Well, let's reconsider the exercise. Instead of having the amount of net income we've already determined, what if net income were $18,000? How would the facts be different? Again, I suggest you draw a schedule. Enough columns to describe what's happening, one for each partner, and then the total. Don't forget the total. It's important. And then a row for each step, each component of their agreement. In our case, interest, salary, and the remainder. Most of the agreement's the same. They have interest at 10% on their original investments, they have salaries of 15 and 20, and the rest they're going to divide 2 to 1. The difference this time is net income is $18,000. Let's start there. Let's put the $18,000 on the schedule and allocate what we know. 10% of their original investments turns out to be $6,000 for C and $4,000 for D, a total of 10. The salaries for the time that they invest were 15 to the first partner and 20 to the second. In this step, we allocated 35. Uh-oh. Don't you see the problem? Don't you see the benefit of having the total column right this minute? We had $18,000 in net income to allocate, yet we've allocated $45,000 to them. It's what to do with this remainder that is different about Part B than Part A. Some of you, if asked, would say this is net loss. And it's not net loss because the problem already said net income was $18,000. It's a negative remainder. We need a negative number there, so when combined with the first two numbers, the sum of this column would be $18,000. We're going to subtract $18,000 from 45 and find that difference to be $27,000. That $27,000 should be allocated to the partners according to their agreement, which was 2-to-1. Let's do that. In thirds, 2/3 and 1/3 of $27,000. 1/3 would be $9,000. 2/3 would be $18,000, but it's negative. It's a negative remainder. Now let's sum. C has $6,000 plus $15,000 minus $18,000, a total of $3,000 as his share of net income. D's share, $4,000 plus $20,000 minus $9,000 comes out to be $15,000 as his share of the $18,000 total. Never, never, never do something like this that you don't cross-foot. Is $3,000 plus $15,000 equal to $18,000? Indeed it is. And we have some assurance that we made the allocation correctly. We would, in turn, make the closing entry for those new numbers. In lecture today, we talked about characteristics, about investments of cash and other items, the division of income and loss. We mentioned admitting partners and partners withdrawing, and liquidations of partnerships. These are some of the major topics we're emphasizing this week, some more than others. You'll want to do a good job and master them, and I hope you do. Have a great week in accounting.